Yeah, hi everybody. Tom Williams here, as usual, speaking to you from Worthing, a nice little holiday resort town on the south coast of England. If you hear a load of seagulls squawking, there is because we're not too far from the beach, and there's a house next door to me where there's some. They love to seem to nest on the top of the roof, and they spend hours flying around squawking. So. But there you are. I enjoy it. I feed them. So we're all happy, I think. Anyway, so thank you very much for showing up and listening to us. I've got Rita here, Rita Offen, and I've got, of course, Peter who's just spoken to you. Now, they can all see my chart, can they, Peter?
Yeah.
Yes.
Right, okay. This is special reason why this particular chart's up, but it's there, and it's the S&P 500 cash market, and this is where the equity lies. It pays you, if possible, to try to read this index. And don't forget the Dow and the NASDAQ and even the futures contract will follow this, because this is where the equity lies. This is where the value of the stock market lies, in this cash market. And there's what they call arbitrage traders out there that ensure that they all move together, because they have a mathematical formula. It's the only mathematical formula that I know of that really works, but we can't use it because you need tremendous amount of contracts to make it work, because you have to buy one and sell the other instantaneously, and you make a profit from the price difference. It's usually way beyond most traders. Even the pit traders stand back when those huge amounts go through on the ticker tape. But so that's why they move together now, and that's why we look at all the three indexes, or we try to, and you will glean all sorts of information from them. Now, so this is a daily chart of the S&P 500. You can see it's trending up. Those trend lines were drawn some time ago, and it's trending up. The first two lows and the first point of supply, which you can see at the top there. There's the first point of supply. We got an automatic signal on there, look, telling us
No
demand, and that's why it's come off, because the professional money, in their wisdom, are not interested in higher prices. And we've even got a signal here, a test. Now you all know what a test is. A test is when they plummet the market down, and it closes up near the high after you've got some strength in the background. But as I said before, I think we spoke about this one. Somebody at the seminar said to me, what's the place you love to buy? And I said, well, one of them is when you see a red arrow appear like that, and the very next bar is tested. Professional money have seen that, and they want to know if everything's okay. So they ram the market down, and if the volume is low, right, then they know there's no real supply there, right? So that they can ignore that sign of weakness there, which is probably no demand, is it, or something? Yeah, no demand. And then you get these wide spreads up, look, like this. This is, Gavin calls them gotcha bars. And the reason is that, say you were here, and say you're clever enough to spot that was a test, right? But you say, well, just wait and see what happens. And then bang, it's widespread up. And they know what you're thinking, right? Excuse me, you may think you're an individual. You may think you always ignore all the ads on TV and never take any notice of them. But we're talking about statistically as a group. And statistics show that as a group, you all think the same. And that's why that bar's there, and that confirms the fact that there was some strength there. Because widespread up, you now think, oh, well, I've missed that move, haven't I? And then that's it. Or imagine if you'd shorted here, you were short and didn't spot this test, then you'd be rapidly forced to cover at a much, much higher price. And so it goes on. And that's why it's there. It's not there by accident. So you often see this, look, you've got a red arrow and then a test. Then up it goes.
There's a question on that, Tom.
Yeah, let's have it.
Test.
Yeah, important question.
Now's the moment to catch it.
Yeah, so a question is coming from Jack. When Tom was talking about, I think, this bar here, it must have come straight to Jack's mind. Let me read the question. Hi, Tom. I get really confused here, the test, because the volume looks higher than I think it should, or than I should expect. Please, can you comment? So, Tom, you said when you were talking about that bar that the volume was low, but well, you explain, Tom.
Well, you're right, the volume is a bit high, but don't forget this is a daily chart, right? But if you look at a smaller time frame, like 5 minutes, 10 minutes, 15 minutes, you'll see that they tested it and the volume will be low. And then as soon as they see that, right, they jump into the market with confidence, right? And so the volume builds up, or can build up. But that's what's good about a computer, look, because it comes up with a signal and doesn't ask any questions. It doesn't try to be too clever or think too much. It just does what you tell it to do. And if you get the logic and the facts right, then the signal will be good. And that's probably the best way to look at it. But remember, this is a daily chart, right? But it's a good test. Why? Because look, the high is not higher than the close of the previous bar. They rammed it down sometime during the day, so you need to look at shorter time frames if you want to examine that. But on that ramming down, it closed all way up here, top quarter. So there could not have been any selling. But that red signal there, they wouldn't look, that would worry them. They wouldn't want that look because there's no demand. Okay, so they tested it. You see, you see it very, very often. And it's a hell of a good place to suddenly jump in and make a bit of money. And that's why, don't forget, it's a daily chart. I'm sure if you looked at a shorter time frame, even an hour or something will probably show you a better, fuller picture than that. But anyway, that's what that bar is, widespread up. That's not by accident, that's done deliberately, right? As Gavin calls it, a gotcha bar, which is quite a good name actually. It means that it's there to cut you, yes, you personally, out of the trade, or get you wrong-footed. Imagine if you were short, say you shorted it and you didn't see this, and you went out shopping or something, you missed this, and then you have to really cover fast there. And then, because then on the other hand, if you did spot this, and you say, oh yes, I should go long, shouldn't I? Yeah, I'll just wait, see what happens, which is a natural process in your thinking. It happens all the time. And then that happens, you go, oh, well, I've missed a move now, haven't I? And so it goes on. It's all done deliberately. Take my word for it. Okay, well, that's a little test there, look. Not much selling pressure, look. And we've been over this ground before. It's just showing you what the end of the day chart looked like. Now, yeah, the reason why I want you to look at this is because we now have a high. Is it there, Peter?
Yeah.
Okay, now I've clicked the mouse, look, and it draws a line straight across, look. Now that is a resistance to higher prices, right? Now it's no good delving into the whys and wherefores and all the rest of it. You'll find that old highs and old lows are resistance levels, and it requires quite a bit of effort to get through and up through that. Now this is obviously trending up, this market. However, when we reach here, look, we know at the moment, or up to yesterday, it's not really going anywhere. Why? Because it's an up bar. Rita pointed this out as actually why I'm looking at it. It's up on a narrow spread, close in the middle, and there is a slight increase in volume. Well, there is increase in volume, look. That means that there's some supply in the market up to the close of yesterday. And I would have thought that if it's going to trend up to that top trend line, you need a test, a shakeout of some sort to push it up through that resistance level. So it's a good idea always to keep an eye on this market. It's the S&P 500 cash market. Now, Gavin was here last week. He's gone back now. But he said, oh, somebody said you repeat yourself. Well, I repeat myself deliberately. I'm not doing it because I'm senile or anything. I actually try to reinforce what I see into your mind. And the best way to do it, by repetition, keep shoving and pushing the principle, hopefully, into your mind. And because it's very easy to get sidetracked, it's not all that easy to spot all this stuff. Very easy in hindsight, but you've got to train yourself to spot it as it's running live, which is possible. Don't forget, the weakest link in trading is probably you. Now, I say it with all respect, of course, but I could almost, it would be almost correct if, say, you went long and your friend went short, right? Same data, same office, whatever. It's a high possibility that you'll both lose money. So that proves the point that it's the trader very often that where's the weak link. It's just a thought that went through my mind, but I know that goes on. But up to yesterday, look, there definitely looked like supply was present and it was having trouble getting up through that high. Any more questions there, Pete?
Another question here. Actually, before I read that one out, Tom was saying just now about how someone said that Tom keeps repeating himself and that it's not because he's senile. So when I first met Tom, I was sitting here and he was doing a seminar and I was thinking, well, last week I was here and he said something quite similar, and then the third week came along and I thought it's all very sort of similar. He must get bored. And then I thought to myself, well, surely actually it's got to be the same each week. Otherwise, he's making some of it up. If you had to give something different each week, then surely it means that it's not all all the rules aren't hard and fast, so to speak. In other words, he keeps saying the same thing because what he said last week is true and this week is true. So it's not an entertainment show as such, although it may be entertaining for some people. Rita wants to say something.
Yeah, I've really started something here. Anyway, Robert here says, you are doing an excellent job. Keep repeating so it will eventually click and we can trade like you. Job well done. And that's true. I've been listening to Tom more than anyone else, I suppose, on the club, because Peter and I, we both see Tom outside of these webinars, and we are always talking about charts whenever we're here and looking at them. And yes, Tom does repeat himself, but are we listening to what he's saying? And that's what I found. Oh yeah, I can hear someone saying something and I'll hear it and hear it and hear it and hear it. And then one day something happens whilst I'm trading, and I think, oh, yes, that's why he says that. And it's I'm afraid, I suppose, you've got to hear what he says, you've got to listen, take it in, and experience it in some way in your own life. And those two things together work. Okay. Okay, we have a question from John here for you, Tom. Do you ever trade crude oil? If so, why, or why not? Crude oil.
Well, I don't trade crude. Matter of fact, I don't trade a lot, to be quite honest, these days, because I can't see the dome properly. I've got macular degeneration, unfortunately. I can see the charts, but when it comes down to details, and you know, I made my money years and years ago, so money's only important to you if you don't have any or you want some more. And I'm quite happy as I am, but I do some trading, of course. But I don't trade crude oil, but Gavin's always asked me to look at the charts, and I look at them. And yes, it would pay, I know this from past experience, for you to specialize in an area. Now, Rita here, she tends to specialize in the Dow, where Peter, he tends to specialize more in the S&P, don't you, Peter?
I do the Dow now.
Oh, you switch as well to the Dow. An Apple. Yeah, so that's great. Now, you see, as I always say to Gavin when you don't have to lie or try to make things out at all to those that are listening, right? Because we've got automatic signals that appear automatically without the intervention of any human being whatsoever, like strength coming in. Now, the computer picks that up automatically. Now, now you should study that. Why did that signal come up like that? We don't hold any secrets back, right? And then that signal and that result of that bar creating that signal will probably happen thousands of times in the future in your lifetime. And will you be able to spot it? And like this one up here, this is a well-known one. No demand, look. Yeah. Now, that's all automatic. We have absolutely nothing to do with that. It just comes up. Okay, so what I say, and not to mention there's something at the bottom here as well, what I say to people is that what we tell you has to be the truth because we can prove it by these automatic signals. There's no formulas in there. We do not use mathematical formulas. We just use the volume, or which is activity, and on that activity, what did the market do? And here with this one, we know strength came in because when you get a down move, the market becomes vulnerable. Vulnerable. It doesn't come vulnerable up here, comes vulnerable after a down move, where some of the professionals, or all of them, may say, right, okay, we can go in here, look, and we can absorb or buy this market now and take it up and make some money. And that's what they do. So these signals, right, read the dialog boxes. Somebody said people don't read them, but you should study those dialog boxes. And then in time, you'll see it all, won't you? Now, we did a newsletter last week, somewhere around here, on that bar there. And if you read the newsletter, it says Monday, if they test, right, that market's liable to go up. So there's Monday. And lo and behold, what have we got? We got a test, look. A test is a down bar, narrow spread, close in the middle, and the volume is low, less than the previous two. It's colored automatically pink for you by the computer, who's telling you, yes, look, the volume's low, because we use relative volume. Relative to the rest of the volume, it's low. And that means that there's no selling pressure. That's all they need. So they mark it down a little bit in the opening just to try to catch you, stops, all the rest of it. fairly widespread up, which they do, and that's why the market's gone up to there because of this. That's the reason why the market went up for 3 bars. Right there, look. And this happening all the time. Not all the time, but very, very frequently. And the thing is, when it happens, you should recognize it. You should recognize that as we call that a test of the rising market. Now, because this is a daily chart, they may not necessarily always come up with an automatic signal on that. But there is one back here, look, isn't there? Here. But this is a test of the rising market, but in the lower time frames, there's probably several tests showing on that bar. Okay, so that's interesting, isn't it? Now, this was up to Thursday, yesterday. Now, here, Friday, are they going to have a shakeout? Are they going to have a test? We don't know precisely. But if they do, you'll know the reason why, because they're trying to get through this whole top. Right? And if they mark it down, something like that, if that happens, or a shakeout of some sort, then they want to go on up. And that's why you look at these daily charts, important, very, very important. Any more questions on that?
There's a question here. Where's it gone to?
Which one?
About the back testing. Oh yeah. So I can't quite read that, Rita. Who's that from?
From Priyesh.
Priyesh, yeah. Is there any back testing done on VSA? And if so, what are the results? So I think, I suppose, the back testing, I suppose you're kind of referring to those indicators here.
You don't need back testing.
And I know what Tom's going to say, but I'll let him say it. Those indicators there are indicators and not buy or sell signals. But Tom will tell you about that.
That's not our scene, back testing. You don't need back testing. You need a certain amount of chart behind you, yes, but you don't need back testing. It's not a formula. And the reason why I never, ever look at formulas, 50% retracement perhaps, that's about the only one, right? And of course those diamonds is some sort of formula, but even those I don't follow. But the reason why, in my opinion, I think I'm right, but I may be wrong, of course. There's a lot of clever people out there. If there was a formula that worked, then because there's so many clever people out there, backed with big money, then they would know what the formula was. They recognize the formula, and as soon as it started to form, they would jump in the market, and their activity would actually dissolve the formula. It wouldn't be there anyway. And in my opinion, formulas sometimes appear to work, as you say, back testing, because serious money have not traded them. Now, VSA is different because if the market changes, all that happens is the volume or activity changes and the price spread. That's what we look at. You can't get away from the fact is that the markets move on supply and demand. That is supply and demand from the professional side of the market that will throw 5,000 contracts into a trade without too much thought. And that's what alters the balance of supply and demand until another force comes in, which may be they may want to sell. Well, they will do. They like to buy on the low and sell on the high, which is how you do business. And but I don't believe in back testing. You can go back and look at these charts, and I think you'll find that most of the signals are pretty good. Not bad at all. Most of them, look, those last 2 or 3 look are very good. What more do you want? But the thing is, you see, that the big problem with trading is you've got to be patient and wait and find these charts that come up with these signals. And then if you're looking at this chart or a chart and say it's been falling for a week, 2 weeks, and the news is bad. The euro is liable to go bust. Greece is liable to go bust. Right, terrorists are knocking on the door, and the weather's bad. All sorts of things are happening. Drought across America is happening. Right, flooding in England sometimes, and so it goes on. Are you ready mentally that when a signal sometimes appears, you probably don't even see it? And if you see it, you're not ready to suddenly dive in the pool and go in the opposite direction. You're simply not geared up to it unless you can study and understand the principles involved, and knowing that when professional money step in with these huge amounts of money, it's going to alter the balance of supply and demand. And I think you'll find that I'm not far from the truth there. And then you see it going up and say, oh, well, yes, he's all right, but I missed that one. And so it goes on. And even if you get in on the trade, you could easily sell out too soon. That happens very frequently. People say, oh, yeah, I managed to get in on the low. I sold out at 10 o'clock. I could have made a lot more money if I'd have stayed in. And then, of course, I recommend you follow the simple, what we call the simple trending system to cover that. I mean, here, look, right, if you've gone long, so, right, the simple trending system says, right, every up bar has to be blue. You allow for one down bar. There's one, up, still going up, look. That's the trending system. So if you had a board here, right, and you follow the trending system, you'd still be in up here. But most people get shaken out somewhere. Right.
A few questions here about the newsletter. Parks, when will last week's newsletter be posted in the VSA Club? A very good question, and I've got the same question. We submitted it, but it didn't appear. So I'm assuming there's technical problems still, and I think Gavin's onto it anyway. So I'm sure it will be at some point. So I'm afraid there isn't a newsletter there at the moment. Okay. Yes. There are technical problems still from the problem they had changing over servers, I think. Edmund has a question, a good question here on this chart, Tom. Peter, can you circle the right? Okay.
So there are two bars here. There's that one. Yeah. And then over here is this one. What's the difference?
Yeah, Edmund says, what is the difference between the bars on July 9 and July 16? Why are the results different?
Is that the bar there we're talking about?
That's the first one.
That's the first one.
That's the first one, right. Well, we looked at that, didn't we? It looked like a test, but it was a failed test.
Yes.
Right? Volume, yeah, the volume's it's not low enough, look. The volume needs to be like that, look, there. It needs to be pink. But here it's there, look. The volume is not low enough. But it is a brilliant test. The fact is the volume's still high, that's why it's still come off. But that probably is still marking a level of strength, potential strength. So say we draw a line through there, right, just look. Okay, now where was this bar here?
Yeah, that's the other one.
Yeah, now the volume's pink, look. See? Look. The volume is now low, according to the computer. And yet here, is it?
No,
it's not low.
That one. There.
Oh, sorry, yeah. Now see the difference? This is not pink. Don't forget, it's a daily chart. I mean, that's why I'm always on to Gavin, for Pete's sake. Let's get tick volume in there as well. Because don't forget, you're dealing with people that really don't want you. They're not there to give you any help. And they're certainly not going to give you any help with the amount of volume, true volume. And don't forget, you're looking at 500 stocks here over a daily period. But so the volume is not actually low on there, look. Now here, this is it here, isn't it?
Yeah.
Now it is, look, it's colored pink. So what I'm saying is that there's a subtle difference. May not look much to you between that bar and that bar, but as far as the supply and demand, it's tremendous. And the computer, that's what the computer's looking at, you see. And that's what's good with the computer. It doesn't ask questions, it just does what you tell it to do in advance. So in other words, all the thinking has been done in advance. And therefore, when it happens, you don't have to think and question the whys and wherefores. You should, when you see a test like that, you should go along. And also, there's another big difference here.
Yes.
It's lo and behold, we've got strength behind us here. And that's a test in the rising market because we've got strength here. Now this one back here, there, that it?
Yeah.
You've got weakness behind you.
Yeah.
Oh, weakness. There it is, look. Down, down, down. Where's the strength? Now that's a vast difference, look, between that and this. Because here, not only is the volume lower, which the computer tells you it is, but you've got strength behind you, look. It's a test. That's why it's a test in the rising market. Now, you should definitely all be able to see that.
Yes, and well done to Jerry, who spotted that. He says the first test bar is in a minor downtrend, while the second test bar is in an uptrend. That is what makes a difference. Yes, so correct, Jerry. Okay, James, yes, Philip Friston seems to be able to get his seminars up on the site. You might ask him how. Yes, some people seem to have the ability because something's been fixed for them. Some of us haven't had things fixed. Tom and I certainly can't respond to things in the forum, so we're not being rude or anything, but we have tried to respond to things in the forum and it won't work for us. So it's all in the pipeline, I know, because it's all been flagged up to Richard, who is the technical man, and he's the best one to contact about any questions, I think.
Support.
Oh yeah, of course.
Feedback to
or support@tradeguider.com, AJ, yeah. Okay, question from Peter here. Hi Tom, can one say in general, are the index charts more difficult to analyze than single stocks or currency futures?
Well, sometimes they are, sometimes they're not, the simple answer. But look, this newsletter we do, we produce this newsletter like you would go to church every Saturday or Sunday, religiously. Rita comes up here and types, she's a wonderful typer. Peter here, he pulls and twists all the right knobs at the right time. And we produce it religiously. It's there. Now, if it's not up on the site, it's something wrong with Richard Becknell. He's the boy. And he's the squeaky door gets the oil. You know, I mean, we're almost thinking about, well, we don't know what we can do because it's wasting our time. It takes us at least 2 hours to do this newsletter. Breaks into our weekend, especially Rita's and Peter. So we don't mind doing it, but the whole fun of a newsletter is to have it in advance of the opening of the market Monday. It's no good having it a week later or something. In the past, that's happened, and somebody said, oh, well, yeah, it's accurate because you did all that in hindsight. which is kind of a bit irritating, but there you are. But we write the newsletter. It's Saturday or Sunday, and it's up to Richard Betnall, and squeaky door gets the oil. We've tried, but there you are. We're just one gear in the whole works. Keep emailing Gavin Holmes in Chicago, and I mean, we enjoy doing the newsletter. It's good educational for us, because even if you yourself wrote a newsletter, right, you think, well, yeah, but see, if you write a newsletter yourself, right, you don't really, you're trying to get it right, but you can see what you've written in hindsight, and if you're wrong, then you can figure out why you're wrong, and surely that will help you in your analysis of trading. When you do a newsletter, naturally, I put a lot of concentration into it, because naturally I want it to be fairly accurate, or accurate as possible. And up to now, it's been fairly accurate most of the time. But that's what. Now, what was the question?
Okay. In general, are the index charts more difficult to analyze than single stocks or currency futures?
Well, sometimes they are, sometimes they're not. Like, you take the cash index, the one we're looking at, inevitably every Monday, if they're bullish, they're going to test or shake out or something. But because you have these arbitrage traders that ensure they all run together, they've got these formulas, mathematical formulas, where they have to trade thousands and thousands of contracts, where they buy one lot and sell the other at the same time and make a profit, be it small relative to the amount of money they're putting in there on the price difference. And that's roughly how it works. I'm sure there's people out there can explain it better than I can, but that's what they call arbitrage trades. So technically, I would recommend that you check all the main charts. You check the S&P 500, you check the Dow Jones and the NASDAQ, and if you've got it, the futures index, and come to an analysis of all three indexes. And don't forget individual stocks. We don't mention too much about them, but individual stocks is probably the easiest way to make money if you've got the cash and if you don't mind waiting months or a year or two for some profit. You simply buy stocks acting stronger than the index, say when the index is showing a test or a buy signal at the bottom there like that. And you'll find that those stocks will go up faster and quicker than those acting weaker in the index. And if you check that out, you'll see that what I tell you is correct. But you see, as you gain all this information and skill, then your skill as a trader has to kick in. And Rita's finding that out now. She's very good at analyzing these charts. Of course, she deals with bookmakers in England as well, and so she's got to fight them as well, because they're not there to give you any money if they can help it. And so it's a skill, really. The skill of trading you have, but you'll never get anywhere unless you can read these charts.
Okay, some people are suggesting, still on the newsletter, about emailing it to all the club members, and as soon as we've finished tonight, I will suggest that to Gavin and Richard. It requires one of them to do that because they have the list of members, but I will suggest that to them until they fix their problems. You're quite right, Lance, for your comments. Absolutely, I agree. Chris asks, hello Tom, do you pay special attention to inside and outside bars, especially in higher time frame charts?
quick reply, no. I don't, but I've heard of this. They call them inside bars. And I think a few weeks ago or months ago, we drew some trend lines on a chart which showed you them converging into what I call like an arrowhead. And the reason why that is that the supply is getting close to the other side of the coin, and it's been jammed into a tight area, and it needs to break out. And now, I don't follow the inside bars, although I heard about them, obviously. I never followed any of these kind of things you read in books and that. Inside bars, that's all that means, is that the supply and demand has become fairly equal, and it's liable to burst out of there. But you can't beat reading the bars. And if you're patient and waiting until you see that, as you saw on this chart, right, there's at least 3 signals there that you could have made a lot of money on if you just recognized the situation, gone in long or short. There's a lot of information out there which is misleading.
Thanks, Tom. Now, a question from Peter. These are hardly Yao Ming volume bars, and the volume for the full contracts are often different than the cash market. I personally consider it more difficult to analyze. So it's not really a question, it's a comment. So, any questions to come?
What did you say on that last one?
I'll read that comment again from Peter. Talking about the volume, they are hardly Yao Ming, and the volume for the full contracts are often future contracts. So sorry, I can't see it. Future contracts are different from the cash market. I personally consider it more difficult to analyse the futures. Thanks for that, Peter.
We could put up the current charts of the...
Put up the hour or something.
Yeah.
Now, what's that one? That's 1 hour of the S&P future.
Oh, yeah. 1 hour. Sorry. Sorry about that.
Yeah, so if you don't all know, Tom has some difficulty in seeing the screen, which is part of the reason we're here. So back to Tom.
Now, that last comment by Peter, everything is relative. So the futures market, although it will move up and down with the cash market, it's a study in its own right, and it's relative to that chart. And it'll go up and down with the cash market. But don't forget, we're looking at volume or activity, and on that volume, what did the price do? So remember that. It's got nothing really to do with the other indexes, except that it's following up and down movements due to arbitraging. But does that make sense? It's relative to the chart. You don't mix the charts up. That's what I'm saying. You study one chart, right? That's what the computer's doing. Now this is the hour chart here. Look, right? It's been falling, and now while we're talking here, look, there's no supply. They marked it down. Look, that's definitely no supply. Look, and now you'd expect that market to go up. And this is the hour chart. Look, they plummeted down. Right now, there's a line here. I'm not sure what that's there for, but anyway.
That's where you clicked, I think.
Yes. Well, is that an old support level or something?
No, it's your cursor.
Oh, it's my cursor. Okay. Anyway, look. Yes, right, it is. Look, that shows there's no selling pressure in the market. Now, if you were short, you'd want to cover that. That looks bullish. Why? Because look, they marked it down, fresh low ground. The volume is pink. There's no selling pressure on that bar, even on that it's closed top quarter, look. Right now, admittedly, the next bar's down, but if this is down again on low volume, finishes there, then that's going to go up because that's how the markets work. Moves on supply and demand. And Friday, are they trying to have a nice shakeout? So they go up next week through the highs that we saw on the daily chart to the left. Now there's some sort of strength appeared around here, and that could quite possible. They could easily, some buying could have come in. The market opened there, that's why surge in volume, look. And there's buying on that bar, look. So we got buying on it. Looks like buying on all of these bars, and that's why the signals are there. But they're not ready to take a bull move at the moment. They need to accumulate and shake people out and whatever they're doing. We don't care. But there's a surge in volume as the US market opens up, the trading pits. It plummeted down, closed in the middle, really high volume. So there must have been some buying on there. Next bar, look, a blue bar. They had another test. There's still volume there, supply. Right. Now it's getting better, look. Right. Down bar. Right. Closed off the lows. And the volume is now getting lower. However, they still probably want to shake you out, and there it is. I would not be at all surprised if there's not a shakeout. And a sign of strength, because there is no supply present. The biggest danger to the professional market is they're loaded up, right, with holdings, and somebody, when they start an up move, starts selling into their up move. That's a very, very quick way to lose money. And that's why they've got to be certain that the selling has gone before they'll mark that up. And that there bar would indicate that it has. Right? The market's not there to help you. It's devious, it's cunning. That's probably why that bar is down. And but that's certainly there. Looks like a sign of strength. Anything, Bree?
Yes. Lance asks, did you say buy shares that are acting stronger than the index when the index is showing a test, or was it buy shares that act weaker than the index?
No, you buy shares that are acting stronger than the index. In other words, when the index is like now, right, you've got to assume that the index, look at this 1 hour chart, look, has fallen. Now, if you go through your stocks, you'll see that there's probably many stocks that have not fallen. And that you've got to ask yourself why. And the reason is that the big trading houses who have fundamental analysis going on delve into these companies, and they know everything about them. They know the ones that are good and the ones that are not so good and so on. And all that information goes back to the houses, the big trading houses. And therefore, when the index is falling, it's logical that because they know that particular stock is good, for example, then it's not falling. And the reason is they're not selling it. They might even be buying on the wave of selling, which must occur when these indexes fall like this. And so it's acting stronger than the index. In my first book, I've explained that, The Undeclared Secrets of Drive the Stock Market.
brace yourself for this one. Okay, question here from David. I've certainly noticed a whole range of volumes for the same underlying instrument, and often they get revised a day or two later, completely changing the signal, typically at tops and bottoms. How do you cope with this, as obviously the big boys are delaying and hiding volume as best they can? Dark pools, and then I'm afraid I don't understand the next word, but all trying to muddy the water. Or do you just intraday trade?
Well, what you say is true very, very often. Philip Friston knows all about the FTSE in London, and they've got laws built into their system so they can hold the volume back for 36 hours, which is amazing when you really think of it. But we get away, as they say, with murder. For the simple reason is that we're always looking at relative volume. The actual figures, because we don't use mathematical formulas, we're not really interested in that. Everything's relative. So we get away with a lot because of that. And don't forget, not only is it volume, but it's price spread. If you see these bars go down on narrow spread in a fresh low ground, right, you could be fairly certain that there's no selling pressure in there at all. And so keep that in mind. Everything is relative. And that makes our life much, much easier. So we don't have to worry about whether there are a few million out here, a few million off there. Of course, they don't know that, but we do.
Hello, question here from Chris. I'm new to the VSA Club. Can you please tell me where I can find previous chart reading surgery archives? When you say that, do you mean the archived webinars, like this webinar, or there was something created called the chart reading surgery, wasn't there, Tom?
No.
No? What was that called?
Loads of different names, different seminars, different packages.
All right. From Steve Phillip. I can't answer your... Oh, is that...
Contact Trade Guider directly. Steve Phillips.
Right. Hang on, I'll just pass it to Peter.
Yes, Peter here. Yeah, so when you mentioned the name Steve Phillips,
Somebody else has suggested.
Edmonds mentioned Steve Phillips here. From Steve Phillips, he says, now I haven't seen those seminars he's done or webinars, so if that's the case, then contact Trade Guider directly, support at tradeguider.com, or phone them from the website number. You can get the number from the website, because I just don't know the answer to that. So I hope that answers that question, at least to get you there to the point of asking the question of Trade Guider in Chicago.
Okay.
Right, okay, so any other questions? Lance is saying the chap we're just talking about needs to purchase an educational card if he is serious. Now, an educational card, I don't know much about it, but I saw it on the website, is where you buy this card, if you like, as a passport to many Trade Guider products, educational products. So there could be past seminars, past webinars, boot camps, etc., all on recorded media, either downloadable or probably downloadable, I should think, these days. Masterclass chart reading is one quoted by Lance there. The card has been taken off the website currently.
They're only good for 60 days.
They're only good for 60 days. Okay, so that information I gave you about about the passport is probably out of date. Sorry about that.
So what's Eleni want? We've got wheat, sugar and corn.
Eleni is asking about wheat and sugar and or corn. So we've got some continuous contracts here somewhere. Let's have a look.
Yeah.
So, corn. That's nice and gappy, isn't it? So that, Tom, is corn, continuous contract. Tom?
Well, I have these charts thrown at me. I haven't looked at this one before. But, I mean, look, corn, the drought in America, we all know that. It's all on the news, right? So the news is, bad news, but good for the prices, look, of corn. That's why it's gone up like this. However, after these huge moves up like this, I'm just looking in the background. I'm surprised if there's never some sort of indication of strength, and that's it there, I suppose. Can you click on that?
Test after shakeout.
So it's not much of a signal, admittedly, but it's there. Okay. Now, don't forget, they're not there to make your life easy. I remember the syndicate I worked with for 15 years didn't like trading these, what they call commodities. They said it was too dangerous because you can have limit up, limit down, all this stuff going on here. But look, surely now, this looks like a shakeout here, doesn't it? But surely now, you're now vulnerable, surely, to professional money wanting to take profits, which it looks as if they are up here, look. When you see these up bars on narrow spreads like that, that's not a healthy sign for higher prices, even despite the drought going on and all the rest of it. So I would not be interested in that at the moment, unless I wanted to short it. I might consider that. What was the other chart?
Wheat and sugar.
Wheat and sugar. Let's look for
Sugar, yeah.
Like a bit of sugar.
Like a bit of sugar.
Is SB. So that's sugar.
Now that's much more sensible liquid, look. It's been going up some time, look. Again, there's some sort of signal there right in the low, look.
Test after shakeout.
Test, look. But, I mean, these commodities, I mean, they're quite in line with the trade. I mean, could you live through that, look? Limit down on that bar. But sugar now, even here, I always say to Gavin, look, ignore the signals at your peril. And there's one right there, look, of weakness. Now, I'm not saying that you're short on that. I wouldn't short on that, and I wouldn't want to buy at the moment either. But I know that Gavin and I was looking at this sugar several years ago, and it'd been going up like this for a long time. And the professional side wanted to start to unload their holdings that they bought lower down. Now, the only way they can unload their massive holdings, right, is they have to sell into a surge of buying from the outside. Okay, and I remember it well, that suddenly the news, they picked on this African country where they'd had a drought. It was only a small country that grew sugar, but the crop had failed, and that's what they zeroed in on. The rest of the world said, well, we got plenty of sugar. They didn't want to know that. They wanted to zero in on this small African country whose sugar harvest had failed. There's going to be a shortage of sugar. Well, now the big commercial sugar users, Cadbury's Chocolate and all those people, they will get alarmed and they will go in and buy because they must have sugar contracts for the following, for their business following year. And I remember that well. I was with Gavin. We had a good laugh over that. But right now, it's nothing really clear except that it appears to be trending up and there's no massive volume yet, although even on that sign of weakness there, look, it's going sideways because of that there, that weakness it's all there. Now, the reason why you've got to be careful, because if they are bearish, they can have an upthrust. But an upthrust, don't forget, that's an upthrust. An upthrust is only a true upthrust if you have weakness in the background, not strength. Here, look, it looks like an upthrust, but it isn't, because you've got strength behind you. Well, now here you've got a little bit of weakness, and you may even get more. Now if you get an upthrust, then that would be the time to short it. You have to wait for the principle to appear, and you do nothing, right, if you want to trade successfully until you see and recognize the principle. Otherwise, you're just gambling. And that's all I can say about that.
Do you want to do wheat?
We'll do wheat.
And another one, wheat for Eleni.
That's been going up. If I put 100 bars up, that's been
Showing.
like,
We're just showing Tom the longer time frame.
Yeah. You want to do the weekly? Yeah.
We're moving over to the weekly chart. Oh, wow. Blimey.
So a lot of accumulation and then up.
Well, very often, you know, with these commodities, it's not a bad idea to look at the weekly chart. You could see there was some accumulation down here as it went sideways. And these down bars, look, that one particular there, look, no selling pressure at all, look. That's why it went up. So you assume that was all accumulation, and that's why it's going up, look. Now, if you did happen to go along, follow the trending system. Blue up, blue up, blue up, blue up. It's still trending up, look, until some obvious sign of weakness appears. And markets don't like ultra-high volume and up bars. Always keep that in mind, because that means that selling is taking place. And it's selling into these up bars that cause these prices to fall. It's still going up, though. Put the S&P hour up, Peter.
Yeah.
Well, that's where the market whipsaw. They obviously, the professional money didn't know what was going on, so they whipsaw the market, look. And then once they know, look, they act nice and smooth, look. Once they know the position, that'll be no demand in there somewhere. Right, our chart, the S&P, there's quite a few signs of strength appearing. Right, so that, to me, looks as if they're trying to accumulate. It's not so much weakness, it's strength. Because don't forget, if it's weakness, you have to have an up move behind you. Up. This has got down move behind you. And even here, with all these signals here, they could prove valuable in the future. Because if you draw a line through here, they call that the point of first support. In other words, professional money first arrived here. Right, now this could easily be a shakeout. Now, if that's a shakeout, it means that next week, if this goes up and it falls back down to this line and the volume is really low, then that's bullish. It's going to go up. It's supply and demand. It may be a bit confusing, but if you think about it, the logic is definitely there. And, well, it must be there because that's what the computer's looking at. The logic that I'm telling you, you instruct the programmer and he types that into the code that the program's following.
Okay, thanks, Tom. We're looking at the sugar and the wheat and the, what was the other one?
Corn.
corn. Eleni, who asked about that, said that she was in, I think she was in the wheat, got lucky, and then is now out. So well done, Eleni. When you say you got lucky, probably you were a chart reading at the same time. So so that's about it, folks. We didn't answer all of your questions because we're kind of out of time. We'll just do one more question from Gordon, actually. So I find it difficult to make an entry using end of day on the FTSE 100 and have been looking for 6 weeks. Can you say anything about that, Tom?
Well, it's there. You want to speak to Philip Friston. He specialises in the FTSE.
On the forum.
Ask him on the forum, because he answers them in the forum. Well, I do. If somebody asks me a question, I'll answer anything in the forum too.
When it works for us.
Eh?
We can't access that at the moment, just so people know.
Oh, we can't access it, Peter says.
Philip can.
Philip knows how to do it.
Well, it's been fixed for Philip.
Yes, they are. But as far as the FTSE is concerned, I'm afraid I don't have the chart. But all these worldwide indexes tend to follow each other. I mean, if you see weakness in the S&P, you can probably bet your bottom dollar the FTSE is not going to go in the opposite direction. But it will still work the same as we're looking at all these other charts. They all work on supply and demand. There's quite a bit more skullduggery goes on in the FTSE because they make their own laws for their benefit, for their members. They're not there for you, and that's why they can withhold volume up to 36 hours, but some of the volume, not all of it. And because we look at relative volume, we usually get away with it. But keep plugging away, because remember, the chart is a language, and you can read the chart. It's the language talking to you. And it's like somebody learning Braille. Perhaps it doesn't come in 5 minutes, but it's there, believe me. And we can prove it's there because of these automatic signals that appear. And keep plugging away, and you will have that expertise and knowledge with you for the rest of your life. And I can assure you will never, ever regret it. One more question.
One question here from Chris. I realise the answer to this question will be don't worry about this, but please can you clarify? When I buy a share and declare it is long, what am I buying? Is it always an interest in the company? And if I held it for more than a year, would I get a dividend if one is payable with the share? What proof of ownership do I get? I presume that in Wyckoff's day, the dividend date would have affected when and how prices were manipulated to get the extra income. You got anything to say there?
Well, all I know is that if you buy, you become a shareholder. And if the particular company pays a dividend, of course, if you buy the future, you get nothing. You're just trading a derivative of the cash market. But if you buy a share on the open market, you have a share in that company, and then they may or may not pay a dividend. And if you want any more details, I would suggest you talk to Philip Friston, because he trades in shares all the time, because he's an active fund manager, and he will know far more about it than I do. I mean, all the shares I used to trade are, it's gone, most of them. But talk to Philip Friston about that.
Let's read out the last comments and then we'll close up.
Okay, a few more comments. There's some good news here from Lance. Well, I'm newish and I have now doubled my account in 6 weeks. That's fantastic, Lance. There's some inspiration for others. Just a few more comments for everyone from that last question. Eleni says the brokers hold the shares virtually. Dividends are paid in your account. For Lance, for dividends you must make sure you are on the register. David says, in the US, all shares are held by a central body, so caveat emptor. Is that what it says there? Right. Buyer beware. Can't remember the details, but a net search will do. Thank you all very much for your comments. Anything else to say, Tom, from you?
No.
No.
See you next week.
Have a great week. We'll be back next Friday. Great. Thanks for your comments, everyone. And we'll see you next Friday. Goodbye.